joined by Sam Masudi, our Chief Investment Officer. And hopefully on the Zoom, Karen, do we have Mika Malone? Mika is our principal consultant from Makita Incorporated, I believe coming to us out of their Portland office, although Mika is a world traveler with her other clients. I'm not sure where she's zooming in from today. We'll turn it over to Mika. Mika is going to present you the attributes of the third quarter performance of the Wyoming Retirement Systems portfolio for the period ended 30 September. So numbers are just a little different than the 30 June numbers in the performance comp. It gives you a good idea of how the fund's progressing. So Mika, we'll turn it over to you. Welcome. Thank you.
Thank you so much. Thank you, Mr. Chairman. I will be referencing page numbers. And again, this is Mika Malone for the record with Makita Investment Group, advisor to the Wyoming Retirement System pension. In the document, we have several slides that highlight both where the portfolio sits at the end of September, as well as what performance looked like through the end of that period. I wanted to highlight just a couple of things. If we look at page 3 of 22, you can see the current asset allocation, excuse me. You can see the current asset allocation of the plan, as well as its target policy allocation. And what I think stands out on this page is that you find the retirement system sitting relatively close to targets and certainly within ranges among every asset category in the program. You do see a slight underweight to marketable equity. That is balanced out by an overweight at the end of the period to marketable alternatives and private real assets. Noting that this portfolio does have a reasonable amount of exposure to private asset classes. And so we always expect to see some fluctuation among those assets at the end of any given period. If we move forward to slides 4 and 5, one of the things that we like to do when we're evaluating the performance of the system for this and any other portfolio is to ensure that all portfolio asset classes fall within ranges, which you see on slide 4 in our compliance check. On slide 5, we're looking at the underlying investment level to ensure that each of the asset classes, as well as each of the underlying managers within the program, are adhering to the guidelines set forth for them. This is a combined effort from Makita as well as the custodian bank to the retirement system. And so this page highlights what we find at the end of each quarterly reporting period, which we discuss with staff, the investment committee, and the board of Wyoming. There are no concerns on either of these pages today. We note one small exception to the compliance, which is that the staff at Wyoming have the ability to invest in certain strategies that are over 10% of that portfolio's assets if they get an exception from the committee and the board. There are a few small investments that they have made that fall under that category, and so we note them and footnote them here. If we turn forward to slide 6, we like to look at the portfolio from a variety of levels. Obviously, the long-term health of the program is to pay benefits to members in the state. That is the most critical thing that this retirement system is here to do. The way that we can measure that success is the ability of the plan to pay those benefits, its performance over time, which we look at relative to both its benchmark, what we call reference portfolios, which you'll see on the next slide in a moment, and then also we look at peers. And so slide 6 is a snapshot of this portfolio relative to peers. And this peer group isn't one that we modify in any way. We utilize it from our InvestMetrics platform. It represents all public defined benefit plans over $1 billion that are in their system. You can see as of the date of this printing, that was about 55 to 58 plans. Over time, some additional plans will report into the system. We usually end up with a total of around 60 plans, but I can tell you because I've just this morning received the final peer numbers and they look basically identical to what you see on this page. And a couple of notable items here because there are a lot of numbers as well as a chart that might be somewhat difficult to follow. What we're showing are a variety of time periods, starting on the left with quarter to date and moving all the way to the right to the 10-year period. Both the numbers in the table as well as the chart above are highlighting how your fund, the Wyoming Retirement System, did over each of those periods. It is noted by a green circle. The square bars that you see floating represent the percentiles. So you can see the top quartile in the top blue, then you move to the second quartile, third quartile, and fourth quartile. In investment performance reporting, the top quartile is the best performance of the group. And so you see where your green circle sits among those various time periods, which is in a quite strong position across all time periods noted. I'll highlight specifically that over the quarter, the plan ranked in the 5th percentile, and over the 5-year period, which is what I'd consider more of a full market cycle, you see the Wyoming retirement system ranking 2nd among peers. And so the return there that you see is 7.73% annualized over 5 years. That compares with the blended benchmark return of 5.85%. So a couple of things to note there. The board of the retirement system has control over the asset allocation and the benchmark that's utilized to measure this plan. If the portfolio was passively invested according to that benchmark, it would have resulted in just under top quartile, so still very, very strong performance based on asset allocation. And then the staff goes and invests that portfolio according to the guidelines that we lay out. And that is where that additional performance came into play. And you see that return in the 2nd percentile. So very strong relative performance over the period. If we flip forward to page 7, I'll just briefly note, as I did a moment ago, that in addition to looking at peers, we want to evaluate the portfolio relative to its strategic blended benchmark. So you see on page 7, that strategic blended benchmark is in blue across the page, again, for the same time periods you saw on the last page. We also show the over and under, which is just highlighting for you, doing the quick math as to whether the portfolio has out or underperformed its benchmark in any given period. You see that from the quarter to date period on through the 10-year period, the portfolio has outpaced its benchmark. And if you look at the since inception date, going all the way back to 1983, the portfolio's returned 8.35% on average over time, but it actually trailed its benchmark further back in history. And so some of the additional ways that we look to see if the portfolio is performing aligned with the objectives that we set forth for it are 2 additional blue lines on this page. You see the 60-40 portfolio just a couple of lines down, as well as the 70-30. And we call these reference portfolios. That's just kind of a gut check to say, okay, we have a benchmark. The policy benchmark represents a passively allocated portfolio that looks just like yours. What if you were to do something else? What if you wanted a very simple portfolio? What's the rest of the marketplace doing? And that's where we show those 60-40 and 70-30 portfolios. And you'll find that across all but the 1-year time period, this portfolio has done quite well relative to the 60-40 and 70-30 as well. I wasn't going to go asset class by asset class here, but I did want to just highlight a couple of things when I think about both the quarter and then the 3- and 5-year periods, which again, to me, are representative of a longer term history. Over the quarter, the markets were very challenged. You saw negative performance from both this fund as well as most asset categories on pages 7, 8, and 9. What you find is that equity markets were challenged during the period, given the significance of geopolitical events, Fed rates, et cetera. And then the fixed income markets were challenged for some of those same reasons. And so when we take a look at your portfolio down 40 basis points, what really helped and hurt? The things that hurt were obviously equity exposure. It was a challenged place to be on an absolute basis. And then some of the contributors were in the private side of the market, so private equity. And particularly when we look at the credit side of the market, opportunistic credit, this is on page 9, if you're following along, private debt, and then your marketable alternatives portfolio, which is really some of the hedge strategies and diversifying strategies within the overall portfolio. Some of these same components performed very well over the last 3 and 5 years, with private equity up nearly 27% over 3 years and 22% over 5 years. And that marketable alternatives portfolio also providing a ballast to this fund in what I'd consider both challenged economic environments, so that's downside protection, and it's also kept pace at a pretty reliable level in up markets, which is really notable, and I think a really challenging thing to do in the marketable alternative space. The last page that I'll highlight is slide 10. This page is where we take a look at the portfolio from yet another lens, which is a risk measurement standpoint. It's one thing to produce strong returns. It's one thing for those returns to be strong relative to peers and benchmarks, but we also want to make sure that we're not achieving those returns by taking on unnecessary or undue risk. And we want to understand that any risk we are taking in a portfolio is represented clearly and that we understand it. And so what we look at here on page 10 is the portfolio across a variety of time periods. Again, those same periods you saw on the last several slides. with 1 year through 10 years at the bottom. And we look at a number of metrics. And I won't bore everyone in the room with definitions or too many descriptions here. But what I will say is that we're looking at the return in each period relative to a standard deviation, which is how much does that return move around the middle. And then we use a couple of statistics based on those measurements to evaluate whether the portfolio is achieving its objective in an appropriate manner. And so that's the information ratio, which is using a benchmark in order to decide if the portfolio is doing better or worse than it should be from a risk perspective. And you can see that positive numbers across those information ratios indicate that the portfolio is performing well given the benchmark returns that we're utilizing. And then further to the right, we look at the portfolio on a Sharpe ratio basis. And this is really looking at the portfolio relative to a risk-free rate to say, are you taking risk that aligns with what we can expect? And are you producing returns for each incremental unit of risk you have in the portfolio? And again, a lot of positive numbers here. And importantly, what you see on the Sharpe ratio column is that your portfolio on a risk-adjusted basis looks better than your benchmark in all of the periods that we show on this page. So that means it's a higher number than the benchmark in each case. And to me, that says that this portfolio, relative to the marketplace, is taking an appropriate amount of risk for the returns that it's achieving. So overall, good news, the portfolio is meeting its objectives. It's had a strong trailing year. It's been a choppy and challenging environment. I expect that there will be periods where I'm not able to tell you that you're in the second percentile over 5 years, but certainly the efforts of the board, the investment committee, and the staff at the retirement system have produced what I consider a relatively strong and in some cases maybe one of the best track records in the public fund marketplace. So with that, I'm happy to take any questions, or I'll close by saying thank you for having me.
Thank you very much. Committee, does anybody have any questions? Doesn't look like it. Thank you very much.
Thank you, Mr. Chair.
Back to you. Dave?
Well, thanks, Mika. Thanks, committee. Mr. Chairman, I just would like to highlight one thing that Mika mentioned, but it wasn't always so. You've seen the results that were in the top decile and sometimes almost the top ranked fund, depending on the time period you look at. But Mika noted that if you go back far enough, the 10-year result is a little shy of that. Why is that? It's because if you go back further than 10 years, Wyoming didn't perform well. From 2008 to 2013, prior to Sam's arrival, the fund typically was in the bottom 10% of peer funds. In the Great Recession in 2008, the fund was down 30%. Median fund was only down 26%, 4% difference. In 2011 was another bad year for the markets. Most funds only gained 2%. Wyoming lost 1.5%. And so, and in that year, we were the bottom fund in the peer analysis. So that's the turnaround that has taken place. And it's all because we made an investment to have an investment team, to have a chief investment officer. There was a 2007 management audit report. When it was written, they didn't know they were 1 year away from the greatest financial crisis since the Great Depression. It suggested that maybe it was time that we had an investment staff, that we ceased the practice of having the board select individual stock and bond managers. At that time, there were 14 managers hired by the board, and it was a lay board that was evaluating them. And a lot of board meetings consisted of hearing from a manager, and it was a sales pitch. Those of you that have been on the retirement board as a legislative liaison, and there's several people in the room that have, you know we don't do that. We delegate it to the professionals, and the board sets policy, and we monitor that, and you can see the success. There's more to be done. We know that the back on middle office is not well staffed in the investment department. The investment staff is sometimes diverted from their investing duties to attend to various administrative matters. Those of you that are on the Joint Appropriations Committee, oh yeah, there's a request coming to fix that. But overall, it's been a really good result, and it results from the partnership between the retirement system and the legislature, including this committee and the JAC. So thank you very much.
Thank you very much. Panel, any questions? Is that the end of your testimony?
Mr. Chairman, I hope so.
Thank you very much. Do we need to take public comment on this one? Any public comment?
Treasurer's office is also with me. Treasurer's office.
The treasurer's office.
Yes.
State treasurer's office. Welcome, man.
I invited him once and he turned you down.
Where are we on this thing? Number 8.
I think you're up, Patrick. You're muted.
Thank you, Matt.
Welcome.
Patrick Fleming, State Treasurer, CIO for the State Treasurer's Office.
Welcome.
So, Mr. Chairman, do you want me to start with the performance compensation?
I do.
Great, and I'll try and keep this brief. I know we're tight on time. First of all, I'd like to kind of put together two different components similar to what WRS did between morning and the afternoon session, is just talk a little bit about the performance compensation. When we last met in Jackson, we had talked about whether or not this had been a success, whether you look at it as a success. And similar to WRS's numbers, I just wanted to highlight we have the final numbers now for June 30. And as of June 30, the 1-year return in alpha dollars, the amount that we produced in excess of the benchmark, was $334 million. I want to highlight that every year, the progression that we're making, we're increasing that return. So if you look since inception, it was about $616 million in alpha dollars. So, and just so you all know, the alpha dollars is the return above the stated benchmark. So the question being is this a success? And I get back to the point before when we're saying the total compensation to the team was $750,000 and we produced $334 million in excess return. I just can't think of any investment that you could have that kind of return. So, similar to WRS, what you have done and allowed us to be able to make this, because before when I started, I was one person managing the 19. Now we have a team of 10. So there's a law of diminishing returns. If we have 100, I wouldn't say that we could produce, $3.5 billion, but, when we have the staff and the ability for the people to focus on producing the alpha and, properly compensated for it, I think, it's a home run. Now, the other point, there was a comment from one legislator earlier that in a previous session that saying, do we have the right benchmarks if everyone beats the benchmark year in and year out? And I just want to clarify that that is not the case. Since inception, we've had at least one individual who has not beat the benchmark. And our performance is a little bit different because every individual has their own benchmark to beat, which is 50% of their compensation, and then the total fund, which is another 50. But just to reiterate, it's not a fait accompli that we're going to beat the benchmark. So I just want to highlight that is something that we've put forth. So if we're able to do this year in and year out, which we're not, I guarantee you we're going to have years that we don't. But this is exactly what we're focusing on, because we do not put together the benchmarks. Our job is to beat the benchmark. And so that's really what I wanted to highlight of what we have done in the past, what we're working to do, and hopefully will continue to do. So with that, Mr. Chairman, if you don't have questions on the performance, I'd be happy to, the performance compensation, I would be happy to comment on the most recent September 30 statements, financial statements that were just put forth from RBK.
Seeing no hands, keep going, thanks.
So Matt, do you want to work? There we go. Thank you, Matt. So the first slide I'd like to look at is what we call the quilt slide. And this is a little bit, well, you can see why it's a quilt. It's a little bit of an eyesore. But one thing that I just want to point out that has really not happened in my lifetime, or I can't think of the last time that has happened in the late 70s, early 80s. But if you look at the bond portfolio, which is the Bloomberg US Ag, it's that dark green, and Matt's highlighting that. If you've looked at that, we've almost had 3 years in a row of negative performance. So that is one of the things that really has hurt a fund like ours that has or had a lot of bonds in it. We are reducing that as we're able to go into fixed income markets, but that has been a very strong headwind that we've had to face. The other thing that I do comment all the time, I think this is really the most important thing because we're always looking at the forward returns, is if you look on the right-hand side, the annual statistics. And what the right one is the past performance and what the returns have been, the standard deviation and the Sharpe ratio. And the forecasted 10-year returns to the left side. And the key component of that is if you look at the forecasted Sharpe ratio, and that's our risk-adjusted return, that's our number one mandate. If you notice, just about all of them are much lower. So a decent Sharpe really is like 0.8 or 1 or above 1. If you look at these Sharpe ratios, these are really, really low Sharpes. So I just want to highlight that, again, because of the valuations and some of the things that we're faced with, the next 10 years is highly unlikely to have the same type of returns over the past 10 years. So with that, we're still trying to do some different things and continue to make money, but I just want to make sure when the committee is thinking about things over a long-term basis, it is more problematic in this environment than what it's been in the last 10 years. Okay, as for returns, which is the most important thing that we're looking at. So this is the total fund performance. And as you can see, you have the 1, 3, 5, 10, et cetera, the years of what we have for the total fund. And this includes, for instance, a state agency pool, which is really just a checking account. So that's really not indicative of everything that we're looking at, but it is the total fund, so we always want to highlight that. The one thing that I want to really show you is if you look at the difference, or again, the alpha. And if you go back 20 years ago, 0.4, 0.4, 0.3, 5 years ago, 0.4, 3 years, 0.7, and 1 year of 1, we're trending in the right direction of increasing our alpha. And that is something that we're really focusing on. Let's go to each sub-fund, which is most important, and as you've commented numerous times in this morning's meeting, how important the PMTF is. So the PMTF, which is the largest fund, obviously, and it is, as we're moving it to this quasi-endowment model, we're hoping that we're going to be able to get more and better returns, obviously. That's the focus. So again, looking at the performance increase over the last few years when we started to focus on that, you can really see that so far so good that we're able to enhance the return. But more importantly, as I said, our number one focus is that alpha production. And if you could see we go from 0.4 10 years ago to a 1.7, 170 basis points in alpha production, which is really the main thing that we are focusing on. Now, Risk-adjusted return is one of the biggest things that we've talked about. And when you hear Sharpe ratio, all it is the volatility divided by the returns. That's, the reason. It's a simple analysis. It's just a risk-adjusted return figure. But Matt, if you could go to page 10 to that Sharpe ratio. So as you can see, we have versus the 70-30, which is our benchmark, or not a benchmark, but just a reference portfolio, if you will, because we can't get to 70 because of the structure of the fund. But if you can see, our funds have a higher Sharpe ratio than the 70-30. So similar to WRS, it's really important for us to have this higher risk-adjusted return. And that is something that we focus on. And there's all kinds of other charts I could go in to show other volatility, looking at the vol difference between the funds. But this is really the most important one if you're looking at risk-adjusted returns. The other part that I want to comment on is an update on our internal investment performance. So as you know, that we manage money internally. It's about a third of the portfolio that we manage internally. And so with that, it is, we're really scrutinized about, are we better off to do this internally or just hire external managers? And so I just want to briefly give you an update, because historically, as you know, we've done it in the bond portfolio for many, many years, but now we are just starting to do the internal performance on equities. So first of all, we had the expertise to do it in the bond side. We were able to hire more of the investment professionals to do it on the equity side. And so now that we're starting with the equity returns, internal performance, I want to just highlight that.
What
So
page
if
are
you
you
see-
on, Patrick?
That would be, what is that, Matt? That's page internal 28,
Mr.
I
Chairman,
believe?
page 28.
Yes, 28.
Thank you.
I will quickly add also that we have an updated version, which is why I'm sharing the slides, which we just got late yesterday. So you guys will get updated copies, but if some of your numbers don't jive with what Patrick's talking about, that's why.
They will be very close. It's not that far off, but there was just a few calculations. RVK has done an unbelievable job in trying to get these numbers to us in a timely manner. And because of the private markets have a 3-month lag, it's really difficult. And so instead of showing you June numbers, we wanted to show you September with those lags that are problematic. Anyway, the large cap, like the S&P 500, that market is one of the most difficult markets to beat. So we have a small allocation in the sense of our total portfolio. You could see 85 million, where in the large portfolio, we have 1.76 billion, and that's all in an index fund because most managers can't beat it. So our internal people, Fung and Seth, think that they can do it over time, but we don't put a lot of money into it until we have an established track record. So as you can see, the 1-year return is down 1.13, but financial year to date, they've outperformed 85 basis points. Where we're really putting our focus on is in small cap, and now we just started with international. So if you go down to the international or the small cap returns, as you can see at the bottom, internal small cap, quantamental, and the quantitative. There we have about 206 million invested, but I want to highlight the returns that you see over on the further right. So the 16.9 and 5.35 above the benchmark. So this is really phenomenal alpha performance. And if we can continue to do that, we're going to put more and more money, take the money from the outside managers, the people that we're paying in New York to do this, and manage it internally. So that's kind of been the mantra of what we've been trying to do over the last 7 years. And, knock on wood, so far so good. We've been able to do it. Now, on the international side, we just implemented that program, and we only have 1 month of data, so it is irrelevant from a return perspective, but it's still positive at 20 basis points, and we have 95 million. So in future years, I am going to be highlighting this and showing you the performance and making sure that you understand what we're doing, what we do well and what we do poorly, and what changes we're going to make and where we can try and improve the performance on an ongoing basis. So that with that, I tried to condense everything to make it very short, kind of highlight just some of the main factors. If there's any questions, I'm happy to answer them.
Any questions, panel? It doesn't look like. Any questions, Patrick?
Well, thank you. As far as the performance and the update, that would be the conclusion of that presentation, Mr. Chairman.
Well, thank you very much. Thank you very, very much for the positive report. Any other testimony on this subject? I think that's it. Thank you. Next on the agenda is item number 4, investment modernization. So we have LSO Ian Shaw is going to do a presentation on this.
Thank you, Mr. Chairman. I think what I'll start with is we'll talk about this in a minute, but it's a proposed amendment for one of the drafts that I'll just hand out. Something very simple, but I'll put it in context as I go through the bill drafts here. I think what, in a matter of time, and because we've had a lot of discussion today about the nature of our permanent funds and the way they're structured, it's directly relevant to the two bills in front of us today, particularly the first one, which is LS 043. That's in your package, and it's the bill that we considered at our previous meeting. We had a robust discussion about that, brought it forward as a committee bill with some fairly minor changes. As a reminder of a broader reminder of what that bill does, it takes the Wyoming Wildlife and Natural Resource Trust Fund and the Wyoming Cultural Trust Fund, and it brings them into a solid status that would mimic one of our permanent funds, like the Wyoming Permanent Mineral Trust Fund. It makes sure it has an income account that is basically treated like a reserve account where excess earnings go, and then we fund projects from that income account. One new aspect is that we put a spending policy on that account. And right now, there's a placeholder that spending policy is 5%. But the fact is, we then guarantee that there's a 5% of the 5-year average of market value of the corpus fund will be available every year for grants. And we back up that guarantee with the other funds that are in that income account, much like we do with the reserve accounts with the Permanent Mineral Trust Fund or the Common Schools. Important thing is then we do a couple more features that again are consistent with permanent funds. We provide for a tip back to the corpus once that income account gains a certain amount of money. And we, both these bills for both of accounts make sure that they are able to be invested in equities. We had a quick discussion about that a little bit earlier on, and that language about their investment authority is identical to the permanent funds and other funds where we've allowed that investment authority. So that's the basic, the changes from the last bill are a couple. We actually provided, as we was discussed earlier, the 7 times tip in the amount. It comes out to 420%. So once those income accounts accumulate more than 420% of their spending policy, then the rest of it, then the excess tips back over into the corpus. We also actually provide a transfer from the of monies into both of these income accounts to get them up to 5 times their annual spending obligations. This is consistent with what we did last year, where we funded the reserve accounts to 5 times, but then we will allow them to accumulate as we go till finally they start tipping back to their corpus at 7 times their annual spending obligation.
Ian?
Yes.
Just for the committee's sake, there's a blue sheet on mine that follows these bills, and then behind that, is a little schematic, and it's
Great.
kind of helpful to follow that schematic as Ian is talking about it. That helps make sense out of what he's saying, because we have two different models of the same idea here.
Yeah.
One is the traditional one that we've seen in other areas like the Hathaway, and then a straight endowment model that he'll be talking about later. So
Right.
I think this sheet is the best way to kind of follow what you're saying, at least from my perspective.
Mr. Chairman, thank you for pointing that out. I mean, it's got it on both sides, and one is the endowment model that is LSO 267, and then the other one is the more traditional one that we have now, which is the subject and is described in 43.
Right, and Ian, just as a directive to the committee, I mean, where we're going with this is, at the end of the discussion, we'll be talking about which of these two models the committee would like to move forward with, if at all, but not only whether we move forward, but which model that we want to move forward with. So that gives some context to what Ian is saying.
Perfect. Yeah, thank you, Mr. Chairman.
Thank you.
Appreciate it. The other change, the major change to the bill draft on LSO 43 from the last time, that there was a question during that last meeting about, well, what happens if we put a spending policy, a 5% spending policy, but 1 year the board doesn't grant that much, so they've got some left over. This bill makes clear, and it has to go a couple of different places in the bill, that those monies are carried over to the next year and are not included in that subsequent year's 5%. So it's a cumulative effect. If they save some, they can spend it the next year or the following year. So that language is also in the bill.
Representative Larson.
Thank you, Mr. Chairman. And Ian, wasn't that conversation kind of reflective on that you may have a project that you're wanting to fund that might take multiple years to fund, and that you'd be able to carry that over from year to year and not have it impact your 5% on an annual basis? Is that kind of the rationale behind that?
Mr. Chairman, that Representative Larson, that was part of the conversation, correct? That you would need to go from year to year. Yeah.
Okay.
The other changes, there are a number of small changes. I'd highlight one is, and it's hopefully minor, but on page 18 of LSO 43, there's quite a bit of language in a staff comment about clarifying the Wildlife and Natural Resource Trust account. There was some prior language in there that actually used terms like a continuous appropriation. The language is a bit confusing, and when I talked to the budget fiscal people, they suggested that since we're putting a spending policy in place that says you've got 5% a year, if we also use the language that you've got a continuous appropriation, then it looks like that money never has to be further appropriated, when in fact it has been the long tradition of this legislature to appropriate that money. So I just want to make clear that that language change, and throughout the bill there's language that, subject to legislative appropriation. It's because we put a spending policy on, but it's not intended to change the practice at all, because that's what we have been doing traditionally for these programs. Just wanted to make that very clear.
A little bit on that. The way I read that, it would change because it's continuously appropriated. And so whatever the interest earnings are currently, the board then allocates those, and they don't necessarily have. The only thing that comes back as a large project requires further legislative appropriation of those. The way I read this, now every small project would have to come to the legislature to approve those appropriations. Am I reading that wrong? Because so it is different if we say that it has to be appropriated, because it eliminates the small and large project component on that.
Mr. Chairman, so correct, no, that it doesn't change. And the difference is that the language that says it's continuous appropriated has never been the fact. In fact, every year in the budget bill, we appropriate both the money, the earnings that come out of there for both the small and large projects. And I checked that twice, and I checked with Dawn to make sure I was correct in saying that, because all of that money has always been appropriated by the legislature. They get the earnings, it goes into the income account.
Okay.
But the board has never just taken it to go ahead and spend it. In fact, it's been the subject of the bill. And so it still does require, the language still does say it requires approval for large projects, not for small projects, but there's a difference between the approval of a project and the need for it to have an appropriation.
Yeah, so that makes sense to me now.
Yeah,
So
well, good, and I
we're just appropriating it to the board, and then the board has the discretion on how they award that. on the small projects.
That's exactly right.
All right, thank you.
I think that's an important distinction, just because it is not intended to change the status quo at all. So, Mr. Chairman, that's the changes to LSO 41. And then the other bill is LSO 267. That's the use the word streamlined chart on the backside of that same handout that shows that during the last meeting, the committee asked that we draft a bill that would take these two trust funds and move them into an endowment model. And we discussed what that would mean. What that does here is a couple of things. It removes the inviolate nature of those trust funds. Right now, we've talked about whether statutory, the permanent funds are constitutionally inviolate. These funds would be statutorily inviolate, but we remove that language so that they are no longer inviolate. We then allow the investment of the corpus and all the funds in stocks and equities, et cetera. And we deposit all of the earnings from those investments. Instead of doing it into an income account, we deposit those back into the corpus. And so the corpus account, the trust fund itself, then contains both its cost basis, those things that were originally there, and all its investments. And I just think that's important because we remove the income accounts as part of this process and we treat the corpus as the income counts. Because what happens, we do put a spending policy then on that corpus. Here again, it's a placeholder of 5%. And we fund those projects from the corpus itself at 5% of the 5-year average. In other words, the spending policy again. The important thing, and I think the thing that makes this an endowment model, is that when we ask the treasurer for money every year to fund those projects at 5% of that 5 years average, the treasurer gets to choose from which assets that money comes. They can pick, they can use any part of the trust, the corpus of the trust and its earnings for that purpose. And that gives them freedom, not having to generate income before that to fund a different account. And that, I think, has been the testimony, allows greater freedom and ability to harvest the advantageous assets for that purpose, rather than being forced to produce income like we do in some of our other accounts. I think it's important in this bill draft. It's just this would allow a 5% spending policy. And it could potentially eat into the corpus, but that would be assuming that would be over a long term when the 5-year average of the market value is the spending policy. So the spending policy goes up and down slowly over a 5-year average, which evens out the spending and prevents it from being drawn down. It builds, it allows it to build and we can't spend, or it allows it to go down slower than otherwise. And also, the end of this bill draft also provides, of course, for a transfer of the current monies that are in the income accounts. They have to be transferred back to the corpus, and it provides what you do with outstanding obligations.
Well, Mr. Chairman.
Yes, go ahead.
So a question, Ian. And this is a little bit of complexity when it comes to the way this would actually operate under this. And so it seems to me like we would still probably need the income account, and I'll explain why. It's because the trust fund may actually award monies. It could be $2,000 to $2 million under large projects and stuff. So they're writing checks all the time and paying out of that. How does that affect the treasurer's office who's trying to invest this money when all of a sudden, this month a $2,000 check and a $2 million and a $3 million, and there's 30 checks a month and stuff, and they're writing that out of the corpus. So it seems to me like we would want to keep the income account and just take whatever, again, at the discretion of the investors, to take whatever that spending policy amount is, and then just put that in the income account on an annual basis. And then we're not writing checks against the corpus that we know how. It seems to me it adds so much complexity for the state treasurer's office under an investment scenario that is probably not a very workable situation. So why wouldn't we just keep the income account, and then under the spending policy, that's how much is transferred in there in the corpus, is the corpus, and we're not worried about writing checks out of our savings account. So we still got a checking and a savings. Checking is finite based on the spending policy. But then all that other accounting that would have to come with the complexities of doing 60 or 70 or 80 checks a year out of the corpus seems like I guess it makes sense to me to leave the income account there and just have the spending policy amount roll into there. So it's one transfer by the state treasurer's office for the Cultural Resource Trust Fund or the Wildlife Trust Fund instead of 40 or 50, 60 transfers a year out of the corpus. Does that make sense? I'm worried about the accounting on the backside and the amount of complexity that this adds into the investment staff of trying to figure out just exactly how much that we have to deal with. They're going to have to look at that spending policy every time a check comes in and then readjust.
I'd like to weigh in on that, in that we do have the treasurer's office represented here, and I'll bet they'll have some opinion about that. So if you're done, are you done with your presentation, Ian?
Mr. Chairman, I am, yes.
Okay, thank you very much. And so I would invite the treasurer's office to come forward and talk to us about.
Mr. Chairman, if we could, if Mr. Fleming's available too, I'd like to.
Oh,
Okay, if he's still available.
sure. Yeah, Patrick, are you still with us?
I am. I'm just locked out from
Okay.
the video part. I just need to be approved on the video. Oh, there we go. Nope. I hope you stopped it.
Okay, we have Dawn with us, and she can probably clarify on how it actually worked within your office on these two different methods.
Thank you, Mr. Chairman. Patrick is here to testify, and I'm going to fill in the blanks. We definitely do have some comments about the bills at the bottom line. As I said, Patrick will talk to you about it, but we feel like a combination of these two bills is going to be what'll work the best for these two accounts. We have had an opportunity to meet with both representatives from both trust funds to discuss how this would work for them, and they are here today to testify and talk to you about how they feel about it. As I said, I was just thinking about when Senator Hicks, when you were talking about the complexity, I think we will never come to you in June and say, we advocate for simplifying processes, because all of these bills have made them incredibly more complex. So any attempt to remove complexity, I sincerely appreciate, Senator. And with that, I'll hand it over to Patrick for his prepared comments.
Thank you, Don. Mr. Chairman.
Yeah, go ahead.
Yes. So in general, just as Don alluded to, there's a combination of both parts that make sense. And first, I want to comment the comment of moving it into more of an endowment account. Just to be clear, the size of the fund matters a lot. So Wyoming Natural Resource Trust Fund has the size to have a broad, diverse asset allocation that would allow it to be into a PMTF-like asset allocation, where the Cultural Trust Fund does not. And with that, the returns of the two different funds would have a different profile. So the less liquid that doesn't have the privates would have somewhere between a 50 to 1% less return than the longer term, larger fund. So if you're kind of 200 million and above, which Natural Resource Trust Fund is, that would fulfill that. But the Cultural Trust Fund, you couldn't do it. We have private funds that the minimum investment is 10 million. So, that just doesn't work. So that's number one. Number two is the inviolate nature of these funds is the one thing that is really causing issues. If you remove and make them no longer inviolate, that's the key, because that frees up everything that we're talking about. So if there's one thing that I would recommend very vociferously, that if you remove the inviolate nature, that is going to allow these funds to spend the income that they have. So as we've talked about this before, the fund could have 100% return, and yet they could only spend 2% of it under the current definition of income if that's all they received in interest income, dividends, or realized capital gains. So that's that archaic nature that we're trying to get rid of all the funds. And the other ones we can't change because, well, we could, but it's constitutionally mandated. But here you have the flexibility to do this. So if we were able to remove that part from these two funds, that frees up the spending. Senator Hicks commented about the checking account, saving account. Absolutely. You have to have the income account for the monies to come in and out. And Katie can comment on that. The other part that I want to highlight is when you're talking about a 5% spend. So let's just go through the numbers. The long-term endowment type of account, which would be for a fund like Natural Resource Trust, that is 200 and above. RVK, not us, has come up with an approximate long-term return assumption of about 6.5%. Right now, inflation is running about 2.5% on a long-term basis. That's the market is forecasting it, not us. So that really, if you want to inflation-proof the funds, that really, brings you down into that much more of that 4% spend as opposed to a 5% spend. And I know we have a chart up there. I sent a chart across that I think would be helpful for people to look at to understand if we could bring that up. Is that possible, just so people understand what I'm referring to? And that's the Wyoming State Treasurer's spending policy and inflation projections.
Mr. Chairman, that is actually part of your packet, but I think it got stuck in some different materials. Let me check here real quick.
It's in the agenda under that heading. So that's what I wanted to, there we go. So unlike the PMTF, where we have other income coming through, the mineral income that you talked about this morning and so forth, that will come through. With endowment type of accounts, which I trust, that's what this is, they don't have, some of them have a lot of money. Harvard, for instance, they had over 500 million a year coming in. But that's not the case here. Unless you appropriate, you don't have those type of monies coming in and year out. So in general, when you're looking for these types of returns, you want to inflation proof them, because otherwise you're just going to spend down the policy. So in this example, I just used $100 as a beginning fund. The 6.5% is what the long-term assumption is by RVK, and the market is telling you long-term inflation is 2.5%. So if we used a 5% spending policy rate, if you look at that over 10 years, the inflation adjusted market value is 86.6. So you're losing, that 13.3. Conversely, I just backed into the numbers, but if you used a 3.75, that is where you would get a $100 investment now, $100 in the future. So just to be clear, a 3.75 spending policy on 200 million, that's where it is today. But 200 million in 10 years at a 31, you see the 131.3, there you're talking about 260 million. So the fund size, your spending policy or your spending amount should be the same if inflation is correct. As the corpus grows on an after inflation adjusted basis, you're the same, whether you're talking about today or in 10 years. So in general, trust funds, endowment funds, and so, what we try to do with our intergenerational equity, we try to make it so today's spending is the same for this generation as it is for future generations. So, you do what you would like to do on the spending policy, but in general, these type of funds would like to have some type of inflation proofing. And then the last point is just saying the policy is up to this rate, whatever you decide, as opposed to it's X, because you want to give the trustees the ability to not spend it if they don't need it and say, oh, well, we have the project next year. We're only going to spend 2.5 this year, but we need to use it for next year. So that's usually what the funds do that allows the trustees the flexibility to not spend it all in 1 year. And I'll leave up for any questions if you have over those comments.
Any questions, panel? Go ahead. Senator Drew.
Thank you, Mr. Chairman. So Patrick, just make sure I got it. So the inviolate nature is what we want to make sure we avoid that and so that's in one of the drafts. And the spending policy, we want to be we don't want to necessarily lock that down because we want to try to get the maximum return and inflation proof the whole show. Right? Do I have that right? Kinda?
Patrick, you want to handle that?
Mr. Chairman and Senator Grew, yes, the inviolate nature is the number one stumbling block, because if you're telling these trustees that you have 4% to spend every year, then that gives them the flexibility to be able to make, project assumptions, what they're going to do and so forth. The way it's structured now, for instance, last year, the Cultural Trust Fund, even though the fund returned 7%, they could only spend like 1.8% of it because our rule of income did not allow them to spend it. So that's the number one problem that not only we face here, we face in every fund we do because of this archaic rule of income. So by doing that, that frees up these entities to be able to do this and allows them the flexibility to have a longer runway to figure out what they're going to do.
Tom, Representative Walters.
Thank you, Mr. Chairman. A couple questions. You had mentioned that the size of the account is important. And so the first question I would have is, with the Wildlife Trust, Natural Resource Trust Fund, and as well as the Cultural Trust Fund, could you combine those two for investing purposes and then differentiate the two on paper for the payout side, to where the smaller fund could still be able to take advantage of the market access that the larger fund would allow for? But that's the first question. Then I'll follow up with a different.
Mr. Chairman, Representative Walters, that's a great question. And if we could do that for all of these funds, it would be nirvana. But unfortunately, we can't, because there's the way that we account for them. It's a subplan accounting that each fund is its own legal entity. So I don't know if you remember, we used to try and get around this by doing in-kind transfers, but our auditor said, no, that's a no-no, you can't do it. You could do it by unitization, which would be something we'd like to do, but is way down the road, multiple years down the road. But no, you can't do it the way that we're structured presently. Each fund has to have that allocation. So if we put $10 million into a private equity fund, we cannot transfer out, and that's what creates the issues. Smaller funds, they just cannot have illiquid assets. And so that's part of our whole reorganization. We're going to have what's called a total rate of return illiquid and a total rate of return liquid. So for instance, the reserve accounts that you were referring to this morning, the reserve accounts, they have to be spent or could be spent. They can't be in the illiquid structure. They have to be in the liquid. The difference is you're going to have a little bit lower return, somewhere in the neighborhood of 50 to 1%, 50 basis points to 1% of a less return for that liquidity. It's, liquidity is worth something. So it's not that much, but it is something. And so, no, you cannot combine them.
Go ahead.
So then, following up that thought, what is the best model for those smaller accounts to still achieve the greatest rate of return?
Mr. Chairman, Representative, I think it's exactly what you allowed us to do last year by putting, more money into the reserve accounts and take them out of an income fund to put them into an investment, is put them into this, what we call total rate of return liquid. So it's still a quasi endowment, but there's nothing in there. The liquidity on it, I would say, probably would be 90 to 95% within a month. We could liquidate 90 to 95% of that within a month. A total rate of return illiquid, you're talking, 15 years in private equity to liquidate. So that's a different model. But this model is really, really good. It's just because of the liquidity function, pool A, reserve accounts, these type of funds could be into this higher yielding asset, which is basically comprised of, of liquid market equities, MLPs, bonds, et cetera. It's still a diversified portfolio, but it's only liquid assets. So it's really a positive model. It's just for that liquidity, you got to pay. You pick up something by investing in illiquid assets.
Mr. Chairman.
Representative Storr.
Thank you, Mr. Chairman. Patrick, I'm just curious why you wouldn't follow a true endowment model for these funds if the spending policy is 5% or less.
Mr. Chairman, Representative Storr, it actually is a true, well, it's almost a true endowment model, because the PMTF is still has the inviolate structure on it. So otherwise, if we didn't have needs for higher liquidity, then we would go for the pure endowment model. But because throughout, whether it's these type of funds that could potentially have a major project, or the PMTF or these other funds that need certain type of incomes and liquidity considerations, then that is what you would do. And I'll just, a quick anecdote so you'll understand what I'm referring to. In the great financial crisis, the true endowment model, I'm going to use Columbia University as an example. They had probably 80+% of their assets in illiquids. The market crashed down. They said, hey, we need the money for this year's spend. And they're like, well, we don't have it. They had to go into the secondary market, and they sold those illiquid investments at 51 cents on the dollar. So that's the true endowment model. But because of our structure, we will, unless you remove the pure inviolate nature of all the funds, we will never get there.
Just to
Follow up?
Patrick, could you provide a liquidity model for the assets in the Permanent Mineral Trust Fund? I didn't see it in the RVK report.
Yes, Mr. Chair, Representative Storr. Yes, if you look, we could send it to you, but just for your own edification, if you look in our investment policy statement, all of the funds will show what type of a liquidity percentage. So the PMTF, for instance, is a 22% vol with a 99% confidence interval.
Senator Hicks.
Mr. Chairman, and this is a follow-up on Representative Walters, Patrick. So the question is we've got two accounts here. One's got over 200 million, and one's 24 to 27 million dollars. And you talked about, so if I heard you correctly, you said so probably the best model for the 200 million because of the access to a much higher yielding asset allocation is to move towards the endowment model. But on these smaller ones, the 24, 25, 27, or under that, let's just say under the 200 million would be to do a reserve account. Is that correct? And so did I hear you correctly there that that wasn't necessarily a recommendation, but right now we're faced with, we got a small one and a large one. And so do we do the same thing for both of them? Or do we do in a reserve account for one and an endowment model for the other? And again, this is as much a question from you guys to the state treasurer's office is how much more complexity do you want?
Mr. Chairman, Senator Hicks, if you want to put in a reserve account, you can, but that is the beauty of removing that inviolate nature. So I don't want to really, I can get into the weeds and tell you exactly, but for instance, right now we're forecasting that liquid, liquid endowment model, let's call it to be a simple term. It's going to have about a 4% yield. So they are going to have the liquidity to be able to do that, but they don't need a reserve account if you can spend down your principal. So let's just say, for instance sake, it's a 4% spend. And we have, historically, we know we've returned at least 2 in the definition of our income. So we have to make up that 2%. In the PMTF and Common School, that 2% would be made up through the reserve accounts. In this instance, we just go out and sell whatever, across the board. We're going to just reduce the portfolio by 2% to make that up. So both of the funds can have the same model. The only difference is one is going to be in a liquid portfolio and one's going to be in a less liquid portfolio. And the spending policy would be slightly different if you wanted to inflation-proof them because of those expected returns. That's, it might sound complex, but it's actually pretty simple if we follow those rules.
Well, say, Mr. Chairman, just to follow up. So for the Wildlife Trust Fund, we talked about 6.5%. We looked at the inflation thing was 3.75 spending policy based on that rate of return of that 6.5 or roughly in that ballpark. So for the smaller funds, it's going to have a lower rate of return, but we also want to inflation-proof those firms. So what, same table you put up there. So with the Cultural Resource Trust Fund, what would be that number for that to allow that inflation proofing of that account for a spending policy? Is it 2 or is it 3% or something between there?
Mr. Chairman, Senator Hicks, if we had, the problem is we ran the model last year for the asset allocation for the Permanent Mineral Trust Fund. That's where I came up with the 6.5. I am using 5.5 for the Cultural Trust Fund just because we had a quasi model, if you will, that came in somewhere between 5.5 and 6. I would guess that this year that's probably where it would come. So I was erring on the side of being conservative at a 5.5 return minus your 2.5. So you're kind of talking in that 3 area after on an inflation adjusted basis.
Yep. That's what I wanted, 3%. So thank you.
And I would guess, and the beauty of this is, let's say 2-3 years down the road, we look at it and say, okay, the numbers are X. We can always tweak it. It's not that this has to be in stone for 20 years if something, if the investment outlook changes dramatically.
Any other questions? I have a question for you, Patrick. On these 2 bills that we have in front of us, are either one of these bills ready to advance, or do we need to hold off and kind of work the issues that you've talked about a little further and come up with and maybe have a Zoom call to approve a little bit better, or is it something we can easily work with one of these models we have here?
Mr. Chairman, I do believe you can work with a model if you just take the amalgam of both bills. And the Treasurer's Office, we work together on this, and Dawn has, the kind of basis of what you could work with, which bill that you could put in a few amendments that would get what we were saying. And so I'd pass that over to Dawn to comment on what we'd need to do to be able to achieve some of the things that we talked about.
Mr. Chairman,
Ian?
I can probably comment for you because I think I hear what their suggestion is. And I think what the problem is that I think the solution might be by using the model that is in LSO 267.
Yeah.
And rather than using a spending policy of 5% or 3% or whatever we decide it is, and allowing that to be spent from the corpus, what if every year you create an income account to which, or a spending policy account, or whatever you want to call it, but the only thing that goes into that is your spending policy amount. So every year you take the amount of grants that you can spend on, you put that in there. All the rest of the earnings go back to the corpus. So this account holds only the money that the board gets to spend. And then you allow that to roll over from year to year, but then you would make an inviolate corpus that gets all the earnings. I think that's simple, and it
Patrick talked about removing the inviolate language, right?
right, and that would.
So that would be one of the pieces to it. But the structure of 267 is adequate for us to deal with here in a timely manner?
Mr. Chairman, I think so, and there would be some conforming amendments that would actually, I think, make the bill simpler, because we wouldn't have to deal with as many things in an income account. So, yeah, I think it would be no more complex.
Senator Hicks.
Public comment on this, and we have the agencies here, and I know they want to talk to the issue and stuff, but it seems to me like what we want to do is direct the LSO to work with the state treasurer's office, and we want inviolate, we want an income account, and we want a spending policy. And that's really the three components that we have to address in there, and get those into one bill. And on the spending policy, based on the numbers that we presented, I would say 4% for the Wildlife Trust Fund and 3% for the Cultural Resource Trust Fund spending policy. That would be at which time that if we want to expedite rather than trying to work these bills, I don't think we can.
Right.
Those are the three issues that I think have to be addressed, that I think that we have some level of agreement on, that we need to get in a bill draft.
So Ian, this being our last meeting, how would we facilitate that draft? Could we have a Zoom meeting of the committee or at some point to consider it, or?
Certainly possible to do. Yes, I mean, I think that I anticipate the bill will be relatively simple and look a lot like what 267 contains now, but I think it would be, this is a fairly large concept, so I think I would be comfortable with the committee taking a look at it and voting on it.
Okay, Patrick, you want to weigh in?
Yes, Mr. Chairman. Yeah, Ian is correct on that. Yeah, and Senator Hicks spot on. If you had those components in it, we would be able to achieve what I believe you're trying to achieve. And we also, you're gonna hear from the representative trustees, but we did have conversations about trying to make sure that what they're looking for would be within the context of what we're trying to achieve.
Okay. Representative Larson.
Thank you. So Ian, thank you, Mr. Chairman, Ian or Patrick or Don, just a little clarification. I heard what Senator Hicks said about establishing the spending policy, but under this new draft, it appears to me that spending policy is flexible and could be done legislatively annually. So are we wanting the spending policy in statute where we can, or do we want the flexibility of doing that on an annual basis? That's cloudy in my mind.
Ian?
Chairman, I can respond to that. Let a policy decisions on which way you want to go, but I can contemplate a workable solution that sets a firm spending policy, and then only that spending policy amount goes annually into an income account from which grants can be made, and that spending policy is clear that grants from that income account make clear that you do not have to spend the full amount of the spending policy, and that whatever you leave in it rolls over from year to year.
Okay.
So, Mr. Chairman, and just to follow up on that, we've got right now the spending policy, the percentages can be adjusted by the legislature at any time. I'm reluctant to do an annual because one year the fund may generate 8% and the next year it could lose 2%. And so right now we've got a trailing 5-year average to flatten that out. To try to do it on an annual basis, I think, is almost folly, because of you're going to run into those years where you may actually have zero, and in that scenario, they don't get anything if there's a down market and stuff. So again, the 5-year trailing average is flatten that out, gives them some assurances. They know next year it's a better planning tool, and there's very less risk associated with doing that. So I think we'd want to keep the 5-year running average of the previous 5 years. And the language you got in there because of the infusion into the accounts, the question I had on that, what happens if we infuse more money into that? That changes the 5-year running average, or does it not? So let's say with the Cultural Resource Trust Fund, we put another $5 million in there rather than 24, it's 29 million, or same thing. Mm-hmm. Does that change that 5-year running average of whatever the corpus is? So it would it not? Mm-hmm. Okay.
And I believe it would.
But I think we have to use that 5-year average. Otherwise, we're going to be no use sawing sawdust. Anyway.
Mr. Chairman?
Yes, Tom.
Thank you. So we also talked about this with the trustees when we met with them, and I'm sure they'll weigh in. We discussed using some language, and I mentioned it to Ian, but he recommended that it's not, probably he doesn't recommend this language, but up to that spending policy, so that the intention would be that we would work with the trust funds each year to discuss what an appropriate expenditure would be based on what the returns have been. And so that adding that up to language is something that we had contemplated that would allow for that for fluctuations. I'm not sure after talking with Ian that that's appropriate language, but I just wanted you to be aware that we had contemplated those issues.
Mhm. Right. Okay, all right. Like to hear from the trustees of these funds. Let them weigh in, and then we'll go from there. Introduce yourself and.
Mr. Chairman, members of the committee, thank you. I'm Bob Budd. I'm the director of the Wildlife Natural Resource Trust.
Welcome.
Thank you. This is an interesting conversation. We've been operating for almost 20 years de facto in a similar manner to what is being described here. If we had our preference in a perfect world, obviously the model that has a reserve account that is fully funded is highly preferable. I don't think that's a possibility, so I'm going to move to the second alternative because I think that is something that we could do. There are 6 items that I would call your attention to that I think need to be addressed. You've already identified 3 of those. One is to remove the inviolate language. That's pretty low-hanging fruit, I believe. That allows us to earn more money. The second, and this is very, very important, is to retain the income account. I think at some level, when you're in the weeds or in the details where we are, there are 6 sub-accounts in our income account today. 3 of those were created by the legislature. We also handle money for mitigation. We took a Rocky Mountain Power Mitigation Fund. That will probably be an ongoing kind of fund. That's handled through the income account. There are numerous different things, money coming in from donations and elsewhere, money coming in from the legislature. That has to have a place to land, and that is the income account. As Senator Hicks referred to, we don't write 60 checks a year. We probably write closer to 200 checks a year. And to do that out of the corpus of the fund, it doesn't make sense, and I think it becomes a burden. Third, I think that we need to maintain the existing balance and somehow in the legislation reflect this. There is an existing balance in the income account, which is, as I referred to, what we have managed as a reserve account since we started in 2005. And that was to deal with the vagaries of inflation, to deal with low earning years. So every year the board and I would sit down and say, this is what we think we can do in the coming year. Here's where your spend is. We have historically been at 4%. I would advocate for that number. That's, if I went back today and looked at all of those 18 years, we've averaged right at $8 million, which is 4% of 200 million. Highest has been 2 years that were 12, lowest are 2 years that were 4, and everything else falls in between that. So that 4% is appropriate. But we do need to maintain those existing balances because there are projects that are in there. As an example, the $10 million that you allocated for migration and highway crossings is in that account, and it is specifically for that purpose. But if all that account gets swept back, that money, that's not where it was meant to be or how it's meant to be used. The fifth, and I want to be sure that I think Ian Shaw has explained the continuing appropriation language to my satisfaction, but there are no reversions in this program, and I want to be sure that that remains the same. That's where that continuing appropriation language, I think, originally was intended to show that it doesn't revert, but that may be covered elsewhere. And then finally, the spending authority, that's one that we just have fixed this year in the budget. You'll see that when you get it. We've had to B11 money almost every year, sometimes 2 or 3 times. And it's because the spending authority was so low that it didn't even reflect what our earnings were, much less what our spending was. So we want to be able to retain the spending authority that is adequate to do not only what the earnings are as they come into the fund, but also other funds that may be out there for multiple year projects or for special projects that you see fit to fund. In the interest of time, I'm not going to get into any specific details unless you have questions. I think this is overdue. I think if you were to go back and ask the people who passed this law in 2005, to ask the 3 governors who have sat in administration, this was really the intent in 2005. And there are a number of them who have said if we just funded the thing to begin with and set it up this way, we'd be far better down the line and far better off. I agree with that, and we look forward to working with you on getting this implemented and stood up. So I'd be happy to answer any questions, Mr. Chairman.
Panel, any questions? Thank you very much.
Thank you.
Anyone else on
Mr.
this
Chairman?
subject?
May I make one comment, and maybe while Bob's still sitting beside me
Sure.
here? I do have a provision I just wanted to find. He had identified the balance that's in the existing income account and how that's handled. If you just wrap it back into the corpus, how it disappears. The current language in the bill provides that any maintaining balances, the income account would maintain those balances, and they would be for the express purpose of meeting their existing obligations. Then if they came up short, they would come from the corpus, and they would count toward a spending policy. I'm just wondering if you think that's adequate, because there is a means for handling existing obligations from the income account. But
Mr. Chairman, I'd need to look at the language to be sure of that, but that is exactly what we have tried to do with that income account over the years, is balance that out. I just want to be sure that we have the ability for that to continue. Just because of a management perspective, it's important to be able to do that. The other thing, and I forgot to mention, that's important that you do know, 4 or 5 years ago, Representative Larson, you were on the select committee and helped co-sponsor a measure that our board has the authority to recommend money that if we don't spend it could go back into the corpus. Some of you on JAC will recall last year we did that. We had $5 million in the income account. We asked that be matched, and it was graciously by the legislature. That went back into the corpus. I anticipate that happening again. We'll have years where if our earnings are at 4%, if our earnings are 8 million, we only spend 2. I think it will become standard procedure for the board annually to say that other 2 should go into the corpus to help continue to build it and to inflation proof it. So just so you know that is there.
Okay, thank you.
Thank you, Mr. Chairman.
Good afternoon. Introduce yourself, and the floor is yours.
Good afternoon. Thank you. My name is Susan Stubson. I'm the chairwoman of the Wyoming Cultural Trust Fund. So let me just briefly make some introductions. Director Glenn has sent his regards. He's traveling to Cody today. Deputy Director Sarah Sheen has some family obligations she's attending to. And you know that adage about things rolling downhill. So you got me, the citizen soldier here. So really quickly, I have with me in the room Nathan Dorr, who is one of our board members, as well as Renee Beauvais, who is our administrator, and the rest of our board members. Brian Beauvais from Cody, Nancy Schiffer, whom many of you know, from Casey, and Mary Hopkins from Laramie, are hopefully listening in on this really important conversation. So thank you very much for your time, and I will try to be brief. A little update as to who we are, what we do, our mission at the Cultural Trust Fund. We're the little guy compared to Natural Resources and Wildlife Trust Fund. But we take our role as board members quite seriously in this fund. Our goal is to preserve, promote, and protect Wyoming's cultural heritage in its simplest form. So I always like to say, everything that makes this state amazing and beautiful and what we love and really encapsulates our Western identity, chances are those were projects that were funded by the Wyoming Cultural Trust Fund. So probably the quickest one, the greatest example is the Cultural Trust Fund was deeply and heavily involved and heavily funded the 4 gorgeous statues that we see in the rotunda every single day. That's, I think, a great, very visual example of the things that we do. Let me also take this opportunity to thank you and your other members of the legislature. Last year, we got an $8 million appropriation into the Cultural Trust Fund. So to answer the question, the current corpus is at $27.7 million. Thank you for that. We have a goal to grow the fund. We have a 30 by 30, grow the fund to 30 million by 2030. We're getting close, and thank you from last year's. That was a really, really significant boost. I appreciate this committee's efforts in updating these spending policies. It definitely sounds like it's time to do that, to help us do what we can on the Cultural Trust Fund to maximize the amount of funding available. At this point, the board is not really available to speak in detail on this draft legislation. We're relying heavily on the treasurer's office. And then the folks, Representative Obermuller, Chairman Obermuller, that's really been working quite hard on this, as well as this committee. And to that point, the board, we have been in Cheyenne for the past 2 days and have discussed this deeply, but there are so many moving pieces that many of the things that we talked about 2 days ago is shifting. And so I'm reluctant to set out any kind of hard ideas from the board, although I would like to encourage you, obviously, to keep us in the loop and in the dialogue. I thought it might be more beneficial to talk about some just long-term goals and aspirations of the board, things that we talk about all the time. Earlier this morning, Madam Chairwoman used the words value statements. Chair Obermuller used the word policies and philosophies. I think that it might hopefully be helpful to you for you to let us know who we are and some things that we talk about that we would like to see reflected in this legislation. It has been a long frustration of this board that we have not had the ability to generate the income off of the corpus that we should. I think Patrick's example of, last year our fund had a 7% return. We were able to use the income from that 1.9%. That is typical. That's not an unusual, that's kind of this position that we've been in for many, many years. I want you to know that there is more need than we are ever able to satisfy. Every single grant, and these are grants that we get, we vet, we study, we read, we know them. So these are great grant projects that come to us. Typically, we are able to maybe fully fund. Our grant amount is up to $50,000. We typically can't fund more than 1 or 2 fully funded. Most of our grants we partially fund. Just as a thumbnail, every grant cycle, we have 2 grant cycles a year. We are only able to fund our projects at about 60%. So this legislation and the idea that we would be able to get a higher rate of return would have tremendous impact across the state. So what would the board like to see out of this legislation? In its most simplest form, we would like to have that ability to grant more dollars, to have a higher rate of return from the income from the corpus. The one thing I do want to talk about is one great source of unease and concern, but I think we can get there, is this language, this inviolate language. There has been I think a cultural and a mindset within the Cultural Trust Fund Board, a fear of doing anything that we can, anything to compromise that fund. I mean, remember our goal, we're fiduciaries of this trust fund. Our goal is to preserve the fund. And so the idea of removing that inviolate language, there's some unease on the board. However, I think that this conversation, frankly, in the past hour and the conversation the board has, I think that we'll get there. It does sound like it's a great idea. I just am not totally comfortable making a statement without visiting with the board about that. But it sounds to me like that's a likely good direction. It would satisfy all of our goals. Therefore, that's really all I have. Thank you for your service to our state. Personally, I understand what that looks like, and I appreciate all of your time and effort, and thank you for looking into this issue. I'd welcome you to reach out to me anytime that you need. And with that, I'm happy to answer any questions.
Mr. Chairman.
Yes, Senator Hicks.
Just real quick, Susan, I appreciate that, but a couple issues. And so while the language says it's inviolate, it's not. I mean, it's not a constitutional trust, so anytime the legislature wants to move that money, and so it's in there, but it's really any body, any session we can move that money. So even though it says that's more of an intent, but we can't obligate future legislators. But to the issue that I want to get to, and I want to make sure that when we're talking for apple oranges, this may or may not result in increased money, because it's going to be based on the 5-year average of what those, and the spending policy. What it does do for you guys is give you reassurances that you know exactly how much money that you're going to have to spend from year to year, much more consistent. But to meet your goal of the 30 by 2030, this is consistent with exactly what we're trying to do without any more infusions of money in there. So I just want to make sure that you guys are supporting. The other side of that is if we get to 30 by 2030 and we don't inflation-proof the account, your purchasing power is whatever it was today. And so you actually lost money. So the question I have for you is, are you supportive? Because this gets to the issue. Do you want a guaranteed amount and be able to spend everything off of that? Or are you also comfortable with the idea that the reason we're doing this is to try to get a higher rate of return to inflation the account, to build the money so that 5 years and 10 years from now, you still have the same purchasing power with this? And so are you okay with the inflation proofing component of that? Because that may come into conflict with we want to spend all of the earnings off of it. And that gets back to the spending policy. So
Mr.
I'm
Chairman,
assuming, based on your testimony, that it was, yeah, we want to inflation-proof it, we want to get to the 30 million and then continue to build from there on out, but.
yes, thank you, Mr. Chairman, Senator Hicks. Short answer, yes, we are in support of this.
Okay, thank you.
And it's not unusual for a number of our grantees, typically historic preservation, these restoration of big buildings, these big projects, they are multi-phased, multi-year projects. And so we do have a lot of grantees that come back to us cycle after cycle. And so we very much would enjoy that consistency. Thank you. That's a great question.
All right, thank you.
Okay, thank you very much.
Thank you.
Other public testimony? Other public testimony? Patrick, go ahead.
Yep, Mr. Chairman, I just want to comment on one thing. When we talk about the 5-year rolling average, how much they can spend, Senator Hicks made a great point there. For instance, Wyoming Wildlife Natural Resource Trust had a large influx of cash in 2021 of 85 million. So one thing you might want to consider is phasing in that 5-year rolling average, because otherwise they're going to be spending less than what they get. So if their fund right now is 200 million, but it was 115, you get 4 years or whatever of your 3 years of 115 and then the 2 years of 200. So in the original bill, or one of the bills, you had the 1 year rolling average. In year 2, it's a 2 year, the 3 year, the 4 year. And then in 5 years, it then is stuck with the 5 year rolling average therefore after that. But that would then allow them to spend the money that they would have now, as opposed to actually going down instead of moving up. I just wanted to comment on that if that's something that you could consider.
So you're thinking along the lines of a kind of a weighted average, kind of a calculation?
Yes, and I don't know, Susan. Susan, do you have a similar type of structure with the 27.7? Did you have a large influx as well? Because that would be an issue. I'm sorry,
Yes.
I didn't see Susan was gone. But that would also be an issue for the Cultural Trust Fund.
Her head is going up and down.
So Mr. Chairman, just to try to again expedite this, I think Patrick's point, that draft is already in one bill. We would want to capture that in the new draft.
Yeah.
That's just
All right,
providing guidance for staff, right?
Right, so panel, my instinct is to not do anything with these bills today, and to have Ian work with Patrick and Director Bud and whoever he wants to consult with. We've heard a lot of Susan Stubbs and others who have an interest in this, and perhaps Senator Hicks, would you take the committee's part of this and work to get a good draft? And when we have it, we'll get together again, we'll set a meeting and just have a quick Zoom meeting and talk about it and try to have something for this session. Does that sound good to everyone? Anyone object to that, or?
Mr. Chairman?
Yeah, Mr.
Thank you, Mr. Chairman. Just for
Representative
clarification,
Walters.
you're discussing a bill that would be an endowment model with the components that Senator Hicks involved, and then some modifications to that, you might say, just to make it all work based on the comments we've heard today. Is that?
Yes, that's exactly right. I think we pursue one model based on the endowment model that we've talked about today. So I appreciate everybody's testimony. It's really helped, I think, to focus on what we need out of this, out of a combined bill. We had two bills, now we're working on one, so I think we've made some progress. I think we can get there. So thank you, everybody, for
Mr.
working on
Chairman?
this. Thank you, Ian.
Great. Just one more question for you. So the existing language in the bill does provide that progressive 5-year average for the Wyoming Wildlife Trust. So you want that for both funds, correct?
I'll let you guys sort that out with, working with Senator Hicks. All right, thank you. Now we move on to item 9, which is spending policy review. Let's see, who's.
I think I'm going to hit.
Treasurer Meyer, welcome to Capital Finance, sir.
Thank you, Mr. Chairman, members of the committee.
For Polly. All right. How are you, sir?
I'm fine. How's the committee holding up today? Good?
We're ready to wrap, so.
Ready? Okay, I'll be
efficient.
short on this one. Just essentially leave everything pretty much the way it is. I know you've got another bill or some discussions about what you do with SIPA and LSRA and those parts of the PMTF. I think those are all policy decisions there. The one policy decision, that I guess in that regard, the simpler you can make those things, for my perspective, the better. But that's my old legislator coming out, and nothing to do with the office that I hold today. But the one thing that I would like to do is recommend that you consider the permanent funds, that you consider that the spending policy be capped in the permanent funds at the current levels that they are. So in the PMTF, the total level, it's a 5% at 5 years. Same thing with Common School, that you cap those at 5%.
Okay.
And that's just so if we have a problem, we don't have a runaway with folks dipping down into those easily anyway. Something that was brought to my attention was and I think you would appreciate this, Mr. Chairman, is a trigger cap that North Dakota has in one of their permanent funds. And essentially it's a conditional access to to part of the funds. And I think in Wyoming, if you use a trigger cap, it would be essentially you couldn't access anything over the 5% unless you previously did a 5% reduction in all other areas of the funding. And then you could access up to an additional 5%. And so those, I know people always say, well, Kurt, I can't get to that, and what if the sky falls? Well, if it actually falls, I guess you kind of define falling to the sky is that the first thing you do is make draconian cuts to everything. And the next thing, if you can't balance your budget with the draconian cuts, then you have access to a little bit of a pool of money. Frankly, I'd rather say you have to go back to the Constitution and to have access in it, but that would be kind of a circuit breaker in those regards. And I think you could work that the same way in Common School, that if things were so draconian that you had to make a cut in the school foundation funds or across the board, then you could have access to some more money within the foundation. So I think it's an interesting prospect. I haven't went into the actual language from North Dakota, but that's the premise of it, is that it would be a kind of a conditional cap. So I'd rather you have no conditions on it, but if you're seeking some conditional access, that might be a way to do it.
Okay, thank you.
And
Thank you. Panel, any questions for the treasurer today? Hey there, you're off the hook.
Okay,
Thank you for,
do that.
thank you for appearing before the committee. Holly, are you ready for us? It looks like she is. Holly, the floor is yours.
Thank you, Mr. Chairman, and hello, committee. I believe that
Would
you
you
all...
like to introduce yourself?
Yes, thank you very much. Polly Scott, LSO Budget Fiscal. And as you know, this committee has a responsibility to report annually to your colleagues in the legislature prior to the convening of the session on any recommended modifications to our spending policies. So the committee received by email a staff-generated draft of your spending policy report for fiscal year 23. It was not posted online because it is a preliminary, and it's really designed to generate committee discussion and direction to staff for how you would like this to be finalized and distributed in February or before the convening of the session. If you would like, Mr. Chairman, I could just summarize that draft.
Yes, please do.
Okay. At the bottom, second to the last paragraph of page 1, it states that the committee recommends no changes to or modifications to the spending policies at this time, which is consistent with the treasurer's written recommendation that he gave to this committee as well. Continues on to say that there's a response to the state treasurer's recommendation to put certain spending policy amounts in the Wyoming Constitution. And to summarize, just states that the committee has gone in a different direction and has moved in the direction of increasing permanent fund reserve balances to overcome impediments to investment performance, and that this was done in conjunction with the state treasurer's office and our investment officials. And as you know, the committee, so this is very familiar to you because you were very familiar with sponsoring House Bill 89, but this explains for your colleagues that that's what was done, and that though House Bill 89 increases the corpus tip thresholds so that those reserve accounts would be able to build up to 7 times annual spending. And then in conjunction with the budget bill from last year, deposits of $639.6 million were legislated to go into those reserve accounts to move them up to the 5 times spending policy amount. Also, at the top of page 3, just indicates that in response to this work that the committee has done and that the legislature adopted, the State Land and Investment Board modified its investment policy statements in June to transition to more of a total return, long-term investment strategy. Moving on to page 4, Table 1 just shows how the spending policy amounts have changed over the years, and that the legislature has been responsive in modifying those amounts when necessary. Then at the bottom of page 4, we start into the information about the duration of the reserve accounts, and those reserve accounts are estimated to have go beyond the forecast period for before exhaustion. So those reserve accounts have been enhanced and strengthened. It shows the available balance as of 6/30/2023 and then 2024. And it also has the increased statutory thresholds before they would tip. And I will note that because the rest of the report goes into the financial results for fiscal year 23 by fund. But to be very brief about it, in fiscal year 23, every fund had a similar pattern where the investment earnings were not up to the spending policy amount, and so reserves were tapped and used to meet the spending policies. And so because of that, our reserve account balances are not quite at the 5 times amount that you're going for. but they are enhanced and more robust. And with that, that's really my summary. The report also has the traditional appendices, Appendix A and B, which were posted online. That's your flow chart and your projections of the reserve account balances for the next 5 years. And with that, Mr. Chairman, I can answer any questions or just would turn it back for committee direction on finalizing the report.
Polly, this on the staff note, the draft represents placeholder language. That language was confirmed today in our meeting, was it not? I think this report, the language that you have as placeholder language, in other words, is appropriate at this point. It's really no longer placeholder language. I think we've confirmed what those were.
Thank you, Mr. Chairman. That's very helpful. Then we can proceed with finalizing a report along the lines of what we have here. Just latitude for, making any refinements or corrections if they're necessary. And the committee may want to take a motion or how.
Right, yeah. Take some discussion here. Panel, anybody want to weigh in on this report? Okay, looks good. Okay, do I hear a second? All right. All in favor of adopting this committee report, say aye. Aye. All opposed? Thank you, Polly, for an excellent job on this. Really appreciate your work. Where are we now? Next.
We're on 10.
Number 10, Pool A, unfunded accounts and minimum size requirements.
Yeah.
We're rolling.
We have 10, 11, 12, and 13 to go. 4 topics.
Nice. Okay, let's see. LSO, oh, here,
10, Pool A investments.
Pool A. And I was going to say, just for the public, we don't actually have a pool here in the.
Mr. Chairman, thank you. This will be a fairly quick bill, I think. It's based on our testimony and our consideration of Pool A over the last 2 years. We've been studying what the membership is in Pool A. It's a statutory established fund that names, I believe, 14 accounts, I think, that participate in Pool A. We had identified some funds that either don't participate or were never funded in Pool A. And so the committee asked for a draft that did 2 things: to remove those entities from participation in Pool A, and then also to set a new limit on new participants in the pool at $5 million. And to go through the bill, that's exactly what it does. On page 2, that new language at the bottom in lines 19 through 22 establishes a new $5 million limit for those who will be added to the pool after July 1, 2022. There's a staff comment on page 3 that just brings up the issue, is that do you want a new pool, a new account that's going to be added to the pool to have a value at $5 million when they begin, or do you need them to maintain a $5 million value? A policy question there. And then on page 3, it shows it's in a stricken form, the 2 paragraphs that will actually be repealed by this bill. And that's just the one that allows the Uniform Unclaimed Property Act participation in the pool and the National Guard Youth Challenge Program endowment account to participate in the pool. Those are the 2 that were either never invested in Pool A or were never funded within Pool A. There's a conforming amendment that goes from page 3 to 4, just because that references a provision that has been repealed. Mr. Chairman, there is a staff comment just because there was some testimony, I believe, that the voluntary pool program subaccount within the emergency water projects account could be included here because it has a 0 balance, but that wasn't part of the bill draft request. So that's the bill, Mr. Chairman.
Okay, committee, any questions for Ian? Representative Walters.
Thank you, Mr. Chairman. I don't know if it's a question for Ian or the Treasurer's Office. based on the staff comment, and I like the idea of saying that they must maintain a $5 million balance. My question comes about if they're teetering on that 5 million, or they deposit 5.1 million, and then the market declines and it forces them down to 4.9 million, for example. How can we create a buffer that says if things are outside of your control, you're not required to maintain that 5 million, but if they're within your control and you withdraw enough to be below it, then you would be kicked out of Pool A? What are your thoughts, and then maybe Treasurer's thoughts or Treasurer's Office thoughts on that?
Well, Mr. Chairman, I can offer my thoughts if you want. I think that would be appropriate. You could always use some sort of a 5-year market value average of their account, so that in any one year they could drop below that, but over a span of a certain number of years, you'd want them to maintain their balance. Because I do think you're right. If they get to a $5 million, they get to participate in the fund, then what happens if the market drops the very next year? The other option is, of course, just as we're doing now, if a fund does permanently drop too low, we could always legislatively remove them, but of course that takes an action like this.
Senator Guru.
Could I ask if that's an idea, but I'd like to hear from the Treasurer's Office if maybe they have some suggestions too, just to make sure that we're.
Patrick, are you there to?
Don.
Or Don? Okay.
Thank you.
There's Patrick. He's still around, hanging in there with us. Who wants to take up the question to discuss this first?
Hi, Mr. Chairman. My name is Katie Smith. I am the CFO for the State Treasurer's Office, and I would love to try to take a stab at that question. So realized losses are not actually distributed to those accounts. They're held in a deferred revenue account. And so I think they would be able to maintain that $5 million threshold even if there are losses on the earnings. We only distribute, the income is what's actually recognized as revenue, and then we hold those until there's enough gains to offset those losses. So I think they would be able to maintain that.
Okay.
So following that up, thank you, Mr. Chairman. If we use the language of a 5-year rolling average of $5 million must be maintained, and then also incorporated within your policy of the realized losses are withheld until they're regained, those two factors should help hold any account above 5 million. But do you agree?
Mr. Chairman, Representative Walters, so the 5-year rolling average, I don't necessarily love. It's complicated, it adds complexity. We do not measure market value at a fund level. We market at a pool level. So a pool is then valued at market value, not an individual fund within those pools. So that makes it extremely complex, and it's one of the comments that I want to make on the bill when I have an opportunity.
You have an opportunity.
Thank you, Mr. Chairman. So on page 2 of the bill, where it speaks to, on line 20, it speaks to the account having that $5 million balance, but at a market value. Again, we don't measure market value at a fund level, but more at a pool level. So I would suggest putting cost value or cash balance as far as maintaining that $5 million threshold as a measurement. That would be extremely helpful for us. We also support the staff comment with maintaining that balance. Obviously, we want to have that balance in there always. We don't want them to drop $2-3 million if they're on the bubble. That's something that, we will consider with any realized losses. So we do support that.
Excuse me, Katie, Mr. Chairman.
Yes.
I want to jump in real quick and say that I forgot my train of thought. I do agree with Katie that we have an opportunity through the language that requires us to withhold losses until gains are realized is already in statute. You all have codified that. So because of that provision, I do believe that that the rolling average is not required, and that this maintenance of that initial deposit is possible. Should it not be maintainable or maintained over time, I think that that's a behooves, it's incumbent upon us to come to you and ask for the account to be removed from Pool A as a result of that. But I do believe that there are mechanisms already within the way, within statute that would allow that to be accomplished without having to establish a rolling average.
Okay. So let me ask, in terms of this bill, is all we need to do with this bill is on line 20, change market to cost, and then this bill works for the Treasurer's Office?
Mr. Chairman, for the most part, we do have some.
I mean, in regard to that item, yeah.
Yes, Mr. Chairman, although the staff comment, I don't think there is any current language that requires the maintenance of that level of investment.
Oh, I see.
I think the staff comment is suggesting that you might want to consider adding some language to that effect, and we would be supportive of that.
Okay, all right.
Mr. Chairman,
Yes, Ian.
that might be very easy. On line 20, you could just say, or account that is added to the Pool A investment account shall maintain a cash balance value of not less than $5 million, period. So I think it would be a very easy change. And then you'd get rid of that as calculated on the date to fund their accounts, because they're going to have to maintain the balance rather than measure it on one
Did
day.
everybody get that?
Okay.
And then,
Go ahead.
Sorry, Mr. Chairman.
Yeah.
Really quick. So on page 3, there's notes about the removal of 2 more funds, like Ian had stated, that have 0 balances. We obviously are in support of that. On page 4, there's talk in the staff comment of the voluntary pool program subaccount that Ian had mentioned. It does have a 0 balance. We would support having that one removed as well from Pool A. And there's one more that does have a balance. It's the Emergency Medical Services Sustained Trust Income Account. However, that balance is $72,000. And so although it has a balance, we would highly suggest that that one be removed from Pool A as well, since it has such a low balance.
Question on that? Mr. Chairman?
Yes. Representative Walters.
Ms. Smith, thank you, Mr. Chairman. Ms. Smith, if we were to remove the volunteer EMT $72,000 account that you just referenced, where would those funds then be transferred to? Would it just go to the state agency pool, or where else would it go?
Mr. Chairman, Representative Walters, exactly. They would go to the SAP, the state agency pool.
Mr. Chairman, there are 2 more staff comments on page 4.
Yeah.
The notion that it formally removes, the second staff comment on line 21, the notation that it removes the funds from the unclaimed property account and the National Guard Youth Challenge Program, we support that. I just wanted you to know that. And then as the next staff comment.
Could you repeat that, please? I just didn't hear what you said.
I'm sorry, Mr. Chairman. On page 4, there's a staff comment beginning on line 20. And on 21, it talks about how it's informing the reader that these unclaimed property account and funds in the Wyoming National Youth Challenge Program endowment account are being removed from being invested in Pool A. And I just wanted to say that we do support that as well. Those are also 0 balance accounts.
Okay.
And then the third comment on the page, beginning on line 28, suggested to ask the treasurer whether it's necessary to provide language. Right now, the LSO is correct. No language is necessary. On line 35, it says LSO believes that these provisions are likely unnecessary since the 2 repealed accounts have never been invested in Pool A, and we would concur.
Okay.
Unless they remove the emergency medical services one.
Okay. And what else do you have for us?
Chairman, thank you. That concludes our comments.
Okay. So on the staff comments, is just go back over there. Was there any staff comment that you disagreed with or that we needed to discuss further from your perspective, or are you in agreement with?
Mr. Chairman, we agree with Ian's observations.
Okay, thank you. All right, who wants to weigh in on this bill? Do some fixing of it? Anybody want to move? Has it been moved? Second? Okay. Discussion, amendments.
Mr. Chairman?
I think public, any other comments? I might have gotten ahead of myself here. I guess we're good. Let's work it here.
Thank you, Mr. Chairman. I'm going to do a couple different amendments just so that it's easier for the committee to track, and for myself to track mainly.
Good.
So I'd start on page 2, and really it would be conceptual and let Ian insert it as needed, but to change that language from market value to cost balance, or whatever that language that was suggested, I would move to do that, as well as to include the language that says they must invest with at least 5 million and then maintain the 5 million in a balance.
Any discussion? All in favor, say aye.
Aye.
Opposed? Okay, that passes. Next.
Mr. Chairman, then I would move to also include the removal of the water account that is discussed in the staff comment, as well as the emergency medical services account that was suggested by the treasurer's office. And I'll note on that water account, it's not the actual water account, it's a sub-account of emergency water funds. So don't want people listening over the internet to think that we're removing a true water account. I use that generically and let Ian do it based on the staff comment. Thank you.
Okay, panel discussion. All in favor, say aye. Aye. Opposed? Next.
Mr. Chairman, then I'd have a question before my next motion, and that really, now that we've included an account that actually has money in it, the $72,000 and change, do we need to include this bottom staff comment on page 4 about how to basically divest out of Pool A and into the state agency pool with that 72,000 and change?
Yeah.
And if so, I would so move to take that appropriate action. And
Mr. Chairman, thank you. I think that might be a question for the treasurer's office, just that if it's no longer permissible and part of Pool A, I think it might naturally move into the other account. But if they need direction to that extent, no problem. So I think their testimony is they don't need direction. I think that can be silent on that point. We just repeal them from participation in
All right.
Pool A.
Okay, back to you, Representative Walters.
I think with that, Mr. Chairman, we're ready to vote on the bill as amended.
Any other comment? Representative Larson.
Thank you, Mr. Chairman. And I think you'll recall back in June when we started this conversation, we looked at those participating funds that were in there, and there was a couple of them that we thought we ought to give some consideration with that are in there that we ought to take the opposite effect, maybe that are less than 5 million, but we ought to maybe bring them up to the 5 million. And so I'd like to make a motion that we fund the public TV fund and the State Fair Endowment Fund. The public television fund's currently at 2.99, and the State Fair Endowment Fund's at 3.4. I can't remember what she told me the other day, but I would move that we would probably create a new Section 3 there or something with an appropriation to fund those up to the $5 million to where they comply with the intent of what this bill's trying to do.
Is there a second? Discussion.
Mr. Chairman, I think to the exact appropriation would probably be done at the time of session because we'd know what the account balance was at that date.
Mr. Chairman, that's correct. We can do that when we prepare the amendment to the bill, and then what we've actually done is then we'll give it our most accurate, and if it changes substantially at all, then LSO will prepare amendment for the first committee meeting, so you'll have the right number.
Okay, thank you. Any other discussion? Ready to vote? All in favor, say aye.
Aye.
All opposed, no. Okay, that amendment passes. Next, Representative Walters, do you have any more for us? Batting 1,000 today. Okay, anyone else? Anyone else on this bill? Question? Okay, here we go. Call the roll.
Thank you, Mr. Chairman. On 24 LSO 0135 as amended. Representative Harshman excused. Representative Knapp. Aye. Representative Larson. Representative Storer.
Aye.
Representative Walters.
Aye.
Senator Driscoll.
Aye.
Senator Furphy.
Aye.
Senator Guru.
Aye.
Senator Hicks excused.
Yes.
Senator Steinmetz excused. Vice Chairman Nethercott.
Aye.
Chairman Obermueller.
Aye.
You
Okay.
have 9 aye and 3 excused.
And,
Local governments.
Local governments. Oh, let's take a 10-minute break. Take a 45-minute.
Take a little nap break.
What time is it? It's 3:09. We'll resume at 3:20. Take it away.
Yep, Mr. Chairman, members of the committee, just here to go over briefly 2021 House Joint Resolution 9. This is the resolution that proposed to amend the Constitution to allow local government entities to invest in stocks. This was adopted by the people at the 2022 general election, and the language is in Article 16, Section 6A2, and it's a new subparagraph C. Simply provides that the legislature may provide by law for the investment of county, city, township, town, school district, or any other political subdivisions funds in stocks and equities. The constitutional language provides that the legislature may designate which of these entities' funds may be invested and which funds that they hold may be invested. The legislature may prescribe different investment conditions for each type and class of political subdivision and for each type of fund. And then any legislation that would establish or increase a percentage of any local fund that may be invested in stocks and equities must be passed by a 2/3 vote of each house voting separately. With that, Mr. Chairman, I stand for questions.
Panel, any questions from Brian? Thank you, sir. Mr. Riemann, join us, please.
Good afternoon, Mr. Chairman, members of the committee. I'm Jeremiah Riemann here on behalf of the Wyoming County Commissioners Association. I see we have an hour and 45 minutes for this discussion. Brian took a minute of it, so pressure is on. All joking aside, and I'm certainly glad, Mr. Chairman, that you're in this seat so that I don't have to avoid words or perhaps identify particular words for you. Mr. Chairman, I'm going to just start out by saying that I won't profess any investment expertise or anything of that nature, but I will try and just quickly articulate the county commissioner perspective relative to this issue and some of the desires that I've heard from them. To just start, of course, my comments are specific to counties, and as Mr. Fuller just mentioned to you, you have a full portfolio of different options that you could, or levers perhaps that you can pull here, which could include all of the entities being eligible or one of those in particular. Again, I'm here to represent counties. And commissioners are interested in activating the authorization that was approved by Wyoming voters. Now, that could take many forms. Certainly, you could look at an approach where the counties or other local governments join alongside the state. You could activate Wildstar 3, similar to the other two programs, but with a more long-term focus rather than a short-term focus. And I will admit this is a preference of my folks, that we have an alternative mechanism that is governed by counties, perhaps with approval or review and approval of the state treasurer or the SLIB board. Those options all could be activated here for this particular constitutional amendment. What I will state from the very beginning here, however, is that I'm not here to advocate that one county go alone. We believe that one or more than one county should be involved in a program that would move forward. I do want to also state that whatever approach is taken, commissioners want to have more involvement and say relative to their county investments. I think that's a pretty solidified desire moving forward. They also would like to see that there are one or more pools that are part of this. And I heard the terms asset allocation used earlier today. Certainly, there are counties with more significant assets than other counties that might want to come into this. So certainly, whatever legislation or counties are involved, we must determine the types of authorized investments, including the minimum investment lengths and the minimum investment amounts. I can envision, for example, a pool that might have a minimum investment amount of $5 million with a 5-year trajectory. Perhaps for other counties with more significant resources, it might be $20 million over a 20-year horizon, or perhaps something more. As I stated before, we don't believe any county should act alone, and we need to not diminish other investments counties make relative to that, but this is serious territory that we're entering here, and it must be taken seriously by those that are involved. We also believe that whatever legislation is put forward should consider the funds that should be invested as is contemplated in the constitutional amendment. We don't want counties investing funds that they need for their immediate or short-term needs. We also need to develop procedures for monitoring, controlling, depositing, and retaining investments and collateral. We also believe that counties must stipulate accounting and reporting requirements, income distribution procedures, and other various things. And of course, at the end of the day, we want to secure the highest return possible while preserving the investment corpus. A question did come up to me from the co-chairs as we began this discussion about what other states are doing. I took that question very seriously and queried my colleagues, and of the 15 that responded to that, at this point in time, only Virginia allows local investment in equities, which is limited to their pension and other post-employee benefit programs and funds. Interestingly enough, it is their municipal and county associations that jointly operate that particular program. I did also find that Alaska's Municipal and County League is considering a very similar move here in the near future. With that, Mr. Chairman, that's the extent of my testimony, and I'd be happy to take any questions, but do appreciate you taking up this topic and do look forward to working with you perhaps through this legislative session into the next interim as we try and activate this authorization.
Thank you, Mr. Riemann. Any comments, questions? Dr.
Thank you, Mr.
Senator
Chairman.
Drew.
Jeremiah, thank you. You talked about Alaska and what they're contemplating doing. Have you talked about that with your counterparts? About maybe having the association have some more active role there?
Mr. Chairman, my counterpart in Alaska, as I mentioned, is looking at standing up an investment pool. I queried whether they needed some sort of a constitutional amendment. They don't believe that they need a constitutional amendment. The last hurdle for them is some sort of a statutory approach. If, Mr. Chairman, their question is, have we contemplated my association doing this? It is perhaps part of the contemplation here. Of course, under whatever parameters might be set forth, that the counties could jointly, and I want to emphasize that because that is something that we're very firm on, could perhaps establish a joint powers board or some other entity to pool their funds under, again, a structure that might be approved by the state and could perhaps be operated by our association.
Yeah, Senator Murphy.
Thank you, Mr. Chairman. Just curious, you mentioned it. Those organizations that have not completed the appropriate reporting, and we at the state are considering withholding their funding until they get those reports in. Have you had a discussion regarding that? Thank you.
Mr. Chairman, yes, Senator, we have that conversation regularly to ensure that counties are timely with relationship to their reports. I can firmly say that the counties are compliant, and ultimately, I think our concern is elsewhere in that system. But yes, we talk about it all the time and have been working along with the Department of Audit to ensure that counties in particular are complying with the most recent requirements for public officer training. And I'm pretty proud to say that we're nearing completion for all county commissioners on that particular mark.
Anyone else? Questions? Does that complete your testimony? Thank you very much.
Chairman, it does.
Yeah, anyone else want to weigh in on this topic? Come on up, introduce yourself.
Thank you, Mr. Chairman. My name is Kirk Schmidt. I live in Lander. I'm retired now, but prior to my retirement, I worked 38 years in the K-12 public school system, and I was the finance director. And normally when I'm talking to the legislature, I'm emphasizing local control. In this case, you need to save some elected officials from themselves. In my 38 years, you can only imagine how many school boards I worked for. And unfortunately, in some of those years, there were people on a school board who were experts in investment. Now, thank goodness, through most of those years, schools were very restricted on what we could invest our money in. And thank you for that, because it kind of saved some things. When you're developing these rules, I would highly encourage you to look at the elected officials in your town, your school district, your county, and ask yourself, do you really want them making decisions on their own without professional advice? So when you're contemplating those rules, one thing that I would encourage you to do is to require whatever entity it is, whether it's a city, a county, or whoever it is, require them to engage professional investment advisors to make those long-term decisions. I mean, this is taxpayers' money. I mean, my worst fear, let me back up. The last couple years, I've had more reports of school districts that were making investments that they didn't recover their principal. My worst fear in my whole life was having to sit in front of a school board and say, well, remember that $5 million we used to have? Now it's 4.5. I mean, that, you know, you need to be very fiduciary responsible in taxpayers' money. When I got into the school business occupation, I worked for a private accounting firm. And my father had been a superintendent back in the days when there weren't finance directors in schools, so superintendents had to make those decisions. And he said, he gave me one piece of advice. He goes, just pretend it's your money. What are you going to do? And I'll tell you what, till the day I retired, that's how I operated. And if I've got to invest $50, $60 million of taxpayers' money, if that was my money, I want to go to somebody who's a heck of a lot smarter than me to make those decisions. That's my only comment, Mr. Chairman, and thank you.
Thank you very much. Any questions for this witness? Yeah, good comments, yeah. So,
Representative, Mr. Chairman, Justin
Welcome.
Schilling with the Wyoming Association of Municipalities. When we went out to campaign for Amendment A in this last general election, the promise that we made to our folks and that they carried to their voters was that this was going to be done in a very responsible manner in the safest way possible. Our vision for that has always been that we would start in any sort of foray into equities with the treasurer's office and dollars being able to be invested through the treasurer's office using the state's investment mechanisms and expertise. Their proven track record is something that we were able to campaign on and definitely firm footing that we were able to use in winning the public's trust for this particular amendment. We do have members similar to the counties that would prefer more flexibility, would prefer the ability to invest in, with outside entities, and we think there could be merit to those ideas. We think the easiest path forward, or possibly the most expedient, would be to look at a WildStar 3 type product. We've had those conversations in part with the treasurer's office, and we think we could very quickly get on the same page with what our members would like to see in that product in a way that we could get that up and running and then continue to explore and educate ourselves and study what it might look like to sort of open those parameters up and look at more options for our municipalities further with proper sideboards and the type of vetting that the state looks at when they consider the investment professionals that they use. So with that, I'd stand for any questions.
Any questions, panel? Thank you for your testimony. Anyone else want to weigh in? How about the treasurer's office? Are you going to speak to this? I assume you have some thoughts.
Thank you, Mr. Chairman, Madam Co-Chairman, members of the committee. I think that was some very good counsel you got from these previous folks that were up here at the mic. Because from what I can recall over the past year, that I can give you some numbers that basically financial literacy in the general population, probably about 45% of the people would be considered financial literate. But investment literacy, I don't know if there's 10% of the people that are financially literate. And I can tell you that there were some interesting conversations we had about durations with even members of the SLIB, who some of them didn't know the difference between an advisor and a manager, and that was frustrating. So the treasurer's office, I think, learned quite a few things, and I think that we have some modifications that we're going to do with both WildStar 1 and 2, and I think would help us in the provisions of a WildStar 3. And these are things about as far as, and I think it was brought up as far as how much you can take out and how much you can put in. WildStar 1, we've got people using it like a checkbook. They'll take out, less than $2 at the end of the month. 2 days later, they'll put, 77 cents back in, different things like that. And so, there's some different parameters, and I think sideboards that we're going to really concentrate on to make WildStar 2 and WildStar 3 a little bit easier to understand. One of the things I think that most people have the hardest time on is with duration. We had one of the SLIB board members that would just told us that the WildStar 2 was just too long of a duration. Well, WildStar 2, the average duration was 1.8 years. And you can go out to 30 years plus. So people don't understand duration, how it works, and had a good conversation with one of the folks from Casper, where they They sold their hospital, had over $100 million. They decided to get out of WildStar 2, and they couldn't understand what, how it actually worked, but they didn't understand the marketing of bonds, that when interest rates goes up and your value of your mark to market goes down. And so, those are things that are, somebody that has some financial literacy understands that. But to the point that was made earlier is that, yeah, you have to have professional investments in it. You can't turn it loose to the people that are sitting on the boards, because it'll be the blind leading the blind. And now we do have some sideboards as far as professional fees that are already in our investment policy statement. And that basically says that you can't charge more than 50 basis points. And so that gives you some, so you don't have, like predatory pricing or something like that as far as the fees that are going to be charged. But I think that there was some different areas that we saw this summer there where our office received letters about what the folks writing those letters thought there was predatory or other things that necessarily bordered on unethical practices in different areas by people who wanted to try to get the investment of some of the funds around the state. So I think it's going to take some deep dives into that. I think the simpler we can make it, probably the better. Allow them the option if they want to have professional investing. I think that's all right, but put some sideboards on it and figure out some kind of a mechanism where you can have some oversight. And I'm not saying that oversight should be in our office, but there's got to be some way to make sure that the folks that are out there are not getting scammed by some of the things that are in the marketplace. I think we've talked about it a little bit, that probably the cheapest way to get market access right now is through ETFs. You could get an ETF on the S&P 500 for 3 basis points. That's hardly anything. That's just like 3% of 1%. So, those are the things that make sense. The easiest one for people to understand is a mutual fund arrangement, because then everything is a par value, $1 in, $1 out, and they know what's going in and what can come out. That's something that I don't think our office would like to manage internally, but there's different mutual funds out there. Usually those things are a lot more expensive than just buying an ETF. So we've had quite a little bit of discussion in different areas. I think the easiest way probably to write the statute is follow the same way that we've done before, is just add duration and add equities in one statute and allow the SLIB board to put it in their investment policy statement. And that would probably give it enough sideboards as far as the main things. But yeah, I think it's going to take a great deal of thought to move this forward and make sure that the people of Wyoming are protected, as the last presenter said, from themselves.
Okay. Yeah, Treasurer, initially, the reason we had as much time in this was allocated as initially I had a bill draft drawn in this area, and then I withdrew that bill draft after having different stakeholders look at it. It just seemed to me like there were some complicated issues surrounding this and too many differing opinions to deal with at this late for this session. So my instinct was to pull that back and to take it into next year and work out how we should really do this. What are your thoughts about that?
Well, I think you could do a WildStar 3 and allow the SLIB to put it in an investment policy statement, but to maybe I think that would be something that you could do. And I think we could get something out there, but I think limit it to, essentially ETFs. And I like the idea of a minimum amount that you can put in, and 5 million is a good start in a minimum amount. It'd get probably a little too difficult to put in a pooling structure that might be for the county commissioners or WHAM, which I think that isn't a bad idea to do that. But you are going to get some folks out there that are going to be charging fairly high fees and running through different levels of investment where, when in our bond portfolio that's managed by JP Morgan, that's only 6 basis points. And they've been basically managing that in the 18th percentile. So that means that there's, they're doing better than 82% of the other bond managers. So but the aspect of duration, that is something that the people out there just don't understand. And so they don't, bonds have always been considered safe, and they are safe if you hold them to maturity. You will not lose, on U.S. Treasuries, you will not lose your money that you put into it, your investment.
Panel, does anyone have any questions for the treasurer? Okay, thank you very much. So any other testimony on this subject? All right, I want to thank everybody that spoke about this today. I think it helps focus and clarify what we're looking at. Panel, what do you want to do with this topic? Anybody want to weigh in on what we should do this year? Does the committee want to do anything with this year? Anyone? No. There's one no. Doesn't seem like there's a lot of enthusiasm. I think based on the timing and where we've been with this, I think we'll more than likely introduce that as an interim topic for this committee and handle it that way. So we'll close our discussion of this particular bill. The last item on the agenda I have is a report from the auditor's office. I have requested that they file their report in writing to us so that we can all move on with our lives here today. Everybody's been hammered pretty good today. So please read those reports when they come in. There are some that have already been filed. And these are related to the audit of our annual financial statement of the state. The outside auditors issued a report in which they found a couple of material weaknesses, a number of significant deficiencies. So it's good for this committee to be aware of what they're finding and what they're reporting on so that we monitor how the agencies are responding to those findings and whether they're getting cleaned up. So I would encourage you to read what has been submitted and to read the one from that the auditor's office was going to report on today, but I let them off the hook and my committee off the hook. I got to protect my members here and let them get home. So yes, Representative Larson.
So Chairman Obermueller's, as I read that report on the findings, and I'm sure that, but just from your professional background, when we see something there that says significant, that to me meant that it needed to be corrected sooner than later. But can you just kind of give us an idea from your background? Is that something there where you work for, or what if they don't correct it, then do you go into a corrective action plan, or how do you normally work through those processes?
Right. Well, if an organization runs the risk of not getting a clean audit opinion if you have a number of those kind of issues that are never resolved. The significant deficiency doesn't rise to the level of maybe that the financial statements aren't credible. But material weaknesses are at a different level, and they have been reported in the past. I think there were a couple of those reported this time. So those kinds of things need immediate attention. We've had them in the past. There are a few of those that are being addressed. There will be written reports about how those are mitigated at this point, and I'm assuming that they have been. But it goes to the auditor's ability to report on the financial statements themselves and give the state a clean opinion, which then goes to things like bond ratings and those sorts of things. So it's an important aspect of the audited financial statements as a state. Those two terms, material weakness and significant deficiencies, are both, they both have specific meanings within the auditing standard that I can't quote to you exactly today because I've been out of the loop for a few years on that. I used to be able to tell you exactly what that said, but at both levels they need correction. So, thank you. Anyone else? Are we ready? LSO, do you need?
Mr. Chairman, yeah, just a couple of cleanup items. First of all, when we do, since we've asked for a new bill draft on that LSO 267, I will check with I was just made sure our bookkeeper isn't in. She's not in. I know we have an extra day for a meeting, although we won't take a day for that meeting, but I'll make sure we have money as well. Otherwise, we'll have to send a letter to Management Council, but I don't anticipate it's going to be a problem for a short meeting. The other thing is we have passed a couple of bills. Did the chairman want to determine where those are going to be assigned for their House assignments, or do you want to do that later?
Later, I will talk to Senator Nethercott and we'll figure it out. The panel need to turn in your, I guess we're getting them gathered here, so if anybody needs to turn in their sheet, just a cleanup item. Happy Thanksgiving, everyone. Thank you, everybody, for your participation in this meeting today. And with that, I think we